Welcome to session 2, Financial Statement Analysis. In session 1, we discussed the preparation and contents of financial statements. We learned that financial statements contain a lot of information. If this information is analyzed and interpreted properly, one can get a valuable insight into the working of the firm. This session discusses the tools and techniques of financial statement analysis. It also discusses certain other aspects of corporate performance. The outline of the session is given here: financial ratio analysis, DuPont analysis, standardized financial statements, applications of financial statement analysis, problems in financial statement analysis, and guidelines for financial statement analysis, balance scorecard, and key performance indicators, business excellence awards. A financial ratio is an arithmetic relationship between two or more numbers found in financial statements. Since financial statements have a lot of numbers on them, a large number of ratios can be calculated. We have to be necessarily very selective, and this is what we intend doing during this session. Financial ratios are broadly classified into 6 categories: liquidity ratios, leverage ratios, turnover ratios, profitability ratios, growth ratios, and valuation ratios. Liquidity ratios reflect the short-term solvency of the firm. Leverage ratios measure the medium-term solvency of the firm. Turnover ratios indicate the efficiency with which various assets of the firm are utilized. Profitability ratios reflect profit margins and rates of return. Growth ratios measure the growth performance of the firm in terms of revenues, profits, and other indicators. Valuation ratios indicate how the capital market views the firm. We will discuss various financial ratios with the help of the financial statements of Horizon Limited drawn from the book Finance Sense. Here is the balance sheet of Horizon Limited as at March 31st, 2000 X1. In this balance sheet, we have figures for the current year as well as the previous year. This is the equity and liabilities portion of the balance sheet. It is divided into three parts: shareholders' funds, non-current liabilities, and current liabilities, and the details are shown here. The assets portion of the balance sheet is given here. It is divided in two parts: non-current assets and current assets. Details of various non-current assets and current assets are shown here. The statement of profit and loss for Horizon Limited for the year ending March 31st, 2000 X1 is shown here. We have information for the current period and the previous period. We have information on revenues, expenses, and net results of operations. Liquidity ratios reflect short-term solvency of the firm. The two most popular liquidity ratios are current ratio and asset test ratio. Current ratio is defined as current assets divided by current liabilities. Current assets are assets which get converted into cash during the operating cycle of the firm or 1 year. Current liabilities are liabilities which are expected to mature in the next 12 months. Current assets provide the sinews for meeting current liabilities. For Horizon Limited, current assets are 400 million, current liabilities are 200 million. The current ratio is 2. Internationally, a norm of 2 is considered satisfactory. In India, for historical reasons, we use a norm of 1.33. So Horizon Limited has a very comfortable current ratio. Asset test ratio is defined as quick assets divided by current liabilities. If we look at current assets, inventories tend to be the least liquid of current assets. So if we remove inventories from current assets, we get quick assets. Inventories for Horizon Limited are 160 million. If you remove 160 million from 400 million, you get 240 million, which is the figure for quick assets. Divide that by current liabilities of 200 million and you get 1.2. An asset test ratio of 1 is considered to be reasonably satisfactory. Leverage ratios reflect medium to long-term solvency of the firm. There are two kinds of leverage ratios, structural ratios and coverage ratios. Structural ratios reflect the structure of equity and liabilities. Coverage ratios indicate the extent to which interest servicing burden is covered. The most important structural ratio is debt equity ratio, also called as a gearing ratio. It is defined as total liabilities divided by total equity. Total liabilities or total debt of Horizon Limited is 500 million, equity is 500 million. So the debt equity ratio is 1. For most of the firms, a debt equity ratio of 1 is considered as a norm. For capital intensive firms, a higher debt equity ratio is allowed, 2 to 1, 3 to 1, or sometimes even 4 to 1. Interest coverage ratio is defined as profit before interest and taxes divided by interest. In the numerator, we have profit before interest and taxes because interest is a tax deductible payment. In the denominator, we have interest burden. PBIT or operating profit is 210 million, interest is 30 million. So interest coverage ratio is 7. In general, an interest coverage ratio of less than 3 is considered to be unsatisfactory. An interest coverage ratio of 5 or more is regarded as fairly satisfactory. Turnover ratios reflect the efficiency with which the assets of the firm, such as inventories, receivables, and fixed assets, are deployed. The key turnover ratios are listed here. Inventory turnover is defined as revenues from operations divided by average inventory. Revenues from operations is a flow measure, inventory is a stock measure. So when we relate a flow measure to a stock measure, we look at the stock measure as an average of the closing and opening inventory levels. Hence, we look at 150 million. Relating 1290 to 150 million, we get a figure of 8.06, which means inventories are turnover roughly 8 times a year. Receivables turnover is defined as net credit sales by average trade receivables. The revenues of the firm are 1290 million. We are presuming that all revenues are credit revenues or credit sales. In the absence of that information, we make this assumption. Divide by average trade receivables, closing trade receivables plus opening trade receivables, divide by 2. So receivables turnover ratio is 9.92. A related measure is average collection period. Average collection period is 365 divided by receivables turnover. 365 divided by 9.92 gives 36.8, which means the average collection period is 37 days roughly. We compare the average collection period with the credit period granted by the firm. If the credit period granted by the firm is say 45 days, and the average collection period is 37 days, the firm is able to collect its receipts in time. But if the credit period granted is 15 days and average collection period is 37 days, collections are very slow. In such cases, we wonder they're receivables or deceivables. Fixed assets turnover is defined as revenues from operations divided by average net fixed assets. Revenues from operations are 1290 million, closing net fixed assets are 500 million, opening net fixed assets are 450 million, so average is 475. Dividing 1290 by 475, we get 2.72. In general, a higher fixed assets turnover means that the firm is deploying its fixed assets very productively. However, there can be a situation where the fixed assets are old, obsolete, and fully depreciated, so their book value may be low and the fixed assets turnover may look artificially very high. Such a high fixed assets turnover ratio may hide cost inefficiencies. Total assets turnover is defined as total revenues divided by average total assets. Here we include non-operating income also of 10 million. So total revenues are 1300 million and average total assets are 950 million. We get a figure of 1.37. Total assets turnover ratio reflects the overall productivity of various assets, fixed assets, inventories, and receivables being the most important assets. There are two kinds of profitability ratios, margin ratios and rate of return ratios. The important margin ratios are operating profit margin ratio, net profit margin ratio, and EBITDA margin ratio. Operating profit margin ratio is defined as earnings before interest and taxes, also referred to as profit before interest and taxes or operating profit, divided by total revenues. In the case of Horizon Limited, EBIT is 210 million, total revenues are 1300 million, so the operating profit margin is 16%. This is a widely used measure because operating managers would like to be judged on the basis of the operating margin. Beyond the operating margin lie interest and taxes. Interest depends on the capital structure policy of the firm, tax depends on the tax code of the government, so the operating managers are not concerned with capital structure policy or tax code because it lies beyond their purview. Hence, this ratio is widely used for comparing performance of various divisions. Net profit margin ratio is defined as net profit divided by total revenues. Net profit is 130 million, total revenues are 1300 million. Net profit margin is 10%. Net profit margin varies from 5% to 15% for most of the firms, and it reflects the kind of competitive advantage the firm has in its industry. EBITDA margin ratio is defined as earnings before interest, taxes, depreciation, and amortization. Quite a mouthful. I warned you that financial terms are very esoteric and daunting at times. This is one of them, but it's a very useful concept. Why do we remove depreciation and amortization in addition to interest and taxes? Depreciation and amortization depends on the depreciation policy of the firm, which is determined by the board. So operating managers would not like that figure to be considered, so they are more interested in earnings before interest, taxes, depreciation, and amortization, a measure of profit which abstracts away the effect of depreciation and amortization policy, capital structure policy, and tax code. In the case of Horizon Limited, EBITDA is 260 million, total revenues are 1300 million, so EBITDA margin is 20%. We often find this margin being quoted in financial press. Rate of return measures are considered as overall measures of corporate performance. There are several rate of return measures. The important ones are return on assets, earning power, return on capital employed, and return on equity. Return on assets is defined as profit after tax divided by average total assets. For Horizon Limited, profit after tax is 130 million, average total assets is 950 million, so return on assets is 13.7%. Though widely used, this measure is internally inconsistent. In the numerator, we have profit after tax, which belongs to shareholders. In the denominator, we have total assets, which are supported by shareholders and creditors. Hence, it is internally inconsistent. Earning power is defined as profit before interest and tax divided by average total assets. PBIT is 210 million, average total assets are 950 million, so earning power is 22.1%. This is internally consistent because in the numerator we have a measure of profit which belongs to both shareholders and creditors. In the denominator we have total assets which are supported by shareholders and creditors. Return on capital employed, or ROCE, is perhaps the most important measure of rate of return. It is also referred to as return on capital or return on invested capital. In finance, we don't have standard terminology, so you will have to live with terminological confusion. Return on capital employed is profit before interest and taxes multiplied by 1 minus tax rate. This is also referred to as net operating profit after tax, or NOPAT. So NOPAT divided by average total assets is 15.5%. This can be compared directly with the weighted average cost of capital, a figure that we'll discuss in a subsequent session. And this comparison is very, very important when we are looking at value creation. Return on equity, also called as return on net worth or return on shareholders' funds, is defined as equity earnings divided by average equity. Equity earnings of Horizon are 130 million, average equity is 475 million, so return on equity is 27.4%. Return on equity can be directly compared with cost of equity. If the on equity is higher than cost of equity, obviously the firm is creating value for shareholders. I mentioned that return on capital employed or return on invested capital is perhaps the best measure of rate of return. Why? Return on invested capital is a better measure of a company's true operating performance compared to measures such as return on equity or return on assets. Return on equity mixes operating performance with financial structure. It cannot be used for cross-section and time series comparisons when financial structures tend to change over time. Return on assets, as we have seen, is internally inconsistent. Growth ratios, the two important growth ratios are sales growth and sustainable growth rate. Sales growth is defined as the compound annual growth rate in sales over a period of time. If the sales of a firm in year 0 are 100 million and the sales of the firm in year 5 are 200 million, we can calculate the sales growth by setting up a simple equation like this: 100 multiplied by 1 plus growth rate raised to the power of 5 is equal to 200. So 1 plus growth rate is 200 divided by 100 raised to the power 1 by 5, which is 1.1487. So the growth rate is 0.1487. In percentage terms, it is 14.87%. Firms would like to ensure that their growth rate is better than the average growth rate of the industry to which belongs, and preferably close to the growth rate of the best performers in the industry. Further, over a period of time, firms would like to ensure that their growth rate is better than the growth rate of the economy to which they belong. Hence, this is a very important performance variable that firms monitor. Sustainable growth rate is defined as the product of return on equity and plowback ratio. If the return on equity is 20% and the plowback ratio is 0.6, sustainable growth rate is 12%. What does it mean? It means the firm can grow at a rate of 12% by relying on internal equity supported by debt in line with the capital structure policy of the firm. Firms have an aversion to raise money by way of external equity because it is cumbersome, it may cost more, and it entails dilution of control. So they have a strong preference for retained earnings, and they have a plowback ratio which is sufficient to ensure that they enjoy a growth rate that can be maintained with the help of retained earnings. If you look at the plowback ratios of firms over a period of time, you find a very interesting picture. When a firm is growing very rapidly, it plows back a very large portion of its earnings because it wants to ensure that most of its equity requirement can be supported with internally generated equity. That is what happened to Infosys during its earlier years when it was growing at a very rapid rate. It was plowing back a very large proportion of its earnings. As a company matures and as the growth rate slows down, the plowback ratio falls, or put differently, the dividend payout ratio increases, as it happened in the case of Infosys. Valuation ratios indicate how investors view the firm. In a way, they sum up the entire financial story of the firm. The value of a firm is determined largely by profitability, risk, and growth, and valuation ratios capture these three dimensions of performance. The important valuation ratios are price earnings ratio, enterprise value to EBITDA ratio, and market to book ratio. Price earnings ratio is defined as market price per share divided by earnings per share. The market price per share of Horizon Limited is 200 rupees. Earnings per share is 13 rupees. So the price earnings ratio is 15.4. This means that investors are willing to pay 15.4 rupees for every rupee of earnings. It's a very popular statistic in finance and widely cited in various ways. Enterprise value to EBITDA ratio Enterprise value is defined as the sum of the market value of equity and market value of debt. In the case of Horizon Limited, there are 10 million shares outstanding, and each share commands a price of 200 rupees in the marketplace. So the market value or market cap of the company is 2000 million. As far as debt is concerned, it is generally assumed that a rupee of book value is more or less equal to a rupee of market value, since the liabilities or debt on the balance sheet of Horizon Limited are 500 million. I have added 500 million to 2000 million to get an enterprise value of 2500. Enterprise value is divided by earnings before interest, taxes, depreciation and amortization, or EBITDA. EBITDA for Horizon Limited is 260. So EV to EBITDA ratio is 9.62. This is also a very popular ratio in valuation. In the last few decades, EBITDA has assumed great significance. Having talked about EBITDA, let us look at the shift in finance for the last 60 years or so. In 1960s, the thrust was on revenues, then the focus shifted to net profit, then the attention shifted to EBIT or operating income. In the last 20-25 years, the focus has been on EBITDA. Now it is moving to free cash flow, a term that we will discuss in a following session. So we find a very interesting historical shift in the attention of financial analysts and investors over a period of time. Market value to book value ratio, also called price to book ratio, is defined as market value per share divided by book value per share. Market value per share of Horizon Limited is 200 rupees. Book value per share is rupees 50. Book value per share is shareholders' funds divided by number of outstanding shares. Shareholders' funds or total equity is 500 million. Number of outstanding shares is 10 million. So book value per share is 50. In this case, the market to book value ratio is 4. In general, we find that the market to book ratio is 2.53, 3.5, 5, even higher. Why is there so much of discrepancy between book value per share and market value per share? It is mainly because book value per share is calculated using the historical cost principle and the conservatism principle. In addition, book value per share does not represent intangible investments or intangible assets. As firms are becoming more and more intangible intensive, financial statements are losing their relevance, because financial statements are based on the historical cost principle, they are based on the conservatism principle, and they tend to reflect only tangible assets or investments of a firm. If a firm has very valuable intangible assets such as brand equity, managerial talent, technological know-how, organizational culture, that is not reflected in accounting statement. That is why market to book ratio of firms like Asian Paints, Hindustan Unilever, Infosys, TCS is very high. These firms are highly intangible intensive. In the last 10-15 years, this ratio has revealed that traditional financial statements are becoming less and less informative. I am reminded of a story. The managing director of a firm was visiting a rural plant along with his chief accountant. They were traveling in a car. They lost their way, so they pulled their car by the roadside and talked to a farmer who was standing nearby. The managing director asked the farmer, "Where are we?" The farmer said, "Sir, you are in your car." The managing director turned to his chief accountant and said, "This farmer is a perfect accountant." The chief accountant was annoyed and he said, "Sir, why are you likening this uneducated farmer to me? I am a highly professionally qualified accountant." The managing director said, "What the farmer told, that we are in our car, is perfectly true, but it has no information value whatsoever." And this seems to apply to financial statements as well. In a presentation made to investors in early 2020, Alok Agarwal, CFO of Reliance Industries Limited, gave information on the changing valuation multiples of Reliance over a period of time. He gave information about the PE multiple, the price to book multiple, and enterprise value to EBITDA multiple. According to him, the market was according higher multiples to Reliance now because Reliance is experiencing a very significant transition in its business model. This perhaps happened after it launched Geo, and Geo attracted a lot of customers and traction over a period of time. And in the meanwhile, a lot of international investors have evinced interest in Reliance. The moral of the story is that market perception drives these multiples. In the case of Reliance, the market now perceives that Reliance has superior growth and profit prospects, and that is reflected in improved multiples shown in these graphs. We have covered a large number of ratios. Let us summarize our discussion. Liquidity ratios reflect the short-term solvency of the firm. The two most important liquidity ratios are current ratio and asset test ratio. Current ratio is defined as current assets divided by current liabilities. Asset test ratio is defined as quick assets divided by current liabilities. Quick assets are current assets minus inventories. Leverage reflects the dependence on debt. The two most important leverage ratios are debt equity ratio and interest coverage ratio. Debt equity ratio is defined as total liabilities divided by shareholders' funds or net worth. Interest coverage ratio is defined as profit before interest and tax divided by interest. Debt equity ratio is a structural ratio. Interest coverage ratio is a coverage ratio. Turnover reflects the efficiency or productivity with which various assets of the firm are being deployed. The important turnover ratios are inventory turnover, receivables turnover, fixed assets turnover, and total assets turnover. Inventory turnover is defined as revenues from operations divided by average inventory. Revenues from operations is a flow measure, inventory is a stock measure. So when we are relating a flow measure to a stock measure, we look at the average value of the stock measure. That is why in the denominator of this ratio we have average inventory. Receivables turnover is defined as net credit sales divided by average trade receivables. Fixed assets turnover ratio is defined as revenues from operations divided by average net fixed assets. Total assets turnover is defined as total revenues divided by average total assets. In this table, we have the ratios of Horizon Limited and the average ratios for the industry. A comparison of Horizon Limited with industry average will reveal whether Horizon is doing as well as the industry average, or is doing better than the industry average, or is doing worse than the industry average. Profitability reflects profit margin as well as rate of return. The two most important profit margin ratios are operating profit margin ratio and net profit margin ratio. Operating profit margin ratio is defined as earnings before interest and taxes divided by total revenues. Net profit margin ratio is defined as net profit divided by total revenues. The most important rate of return measures are return on assets, earning power, return on capital employed, and return on equity. Return on assets is defined as profit after tax divided by total assets. Earning power is defined as profit before interest and tax, which is the same as earnings before interest and tax, divided by total assets. Return on capital employed is defined as profit before interest and taxes multiplied by 1 minus tax rate divided by total assets. The numerator of this ratio is also referred to as net operating profit after tax, or NOPAT. Return on equity is defined as equity earnings divided by equity. Valuation ratios capture profitability, risk, and growth and are a summary measure of how investors view the company. The three most important valuation ratios are price earnings ratio, enterprise value to EBITDA ratio, market value to book value ratio. Price earnings ratio is defined as market price per share divided by earnings per share. Enterprise value to EBITDA ratio is defined as enterprise value by EBITDA. Enterprise value is the sum of the market value of equity and market value of debt. Market value to book value ratio is defined as market price per share divided by book value per share. In this table, we have the ratios for Horizon Limited along with the average ratios for the industry. A comparison of these ratios will enable us to pass a comment or judgment on the relative performance of Horizon. Time series of certain financial ratios. We looked at 18 ratios in the previous table. If I have to choose 5 out of these 18 ratios, this is my tentative list. Debt equity ratio, total assets turnover ratio, net profit margin, return on equity, price earnings ratio. In real life, we have to be selective. We may have to work with 5 to 7 ratios in most of the situations. Further, we have to look at the behavior of these ratios over a period of time to understand the trends in financial performance. Here we have a table which shows these 5 ratios over a 5-year period. Year 5 is 20x1 and you have the figures for the previous year. If you look at the debt equity ratio, you find that it has fallen from 1.3 to 1. So there is a distinct improvement in debt equity ratio. Total assets turnover ratio has remained more or less in the same band. There has not been any significant improvement or deterioration here. Net profit margin improved for few years and thereafter it remained more or less the same. Return on equity also showed significant improvement in the initial years. Thereafter it has remained more or less the same. Price earnings ratio has gently moved up over a period of time from 12.5 to 15.4. A time series analysis of ratios gives us an idea about what is happening to the firm over a period of time. Let us look at DuPont chart pioneered by the DuPont company in the US. In fact, this chart was initially developed by Alfred Sloan, a person who had an engineering background. This chart is widely used internationally to get a pictorial view of the determinants of return on assets. Return on assets, as we have learned, is defined as net profit divided by total assets. So return on assets is a product of net profit margin and total assets turnover ratio, because net profit margin is net profit divided by revenues and total assets turnover is total revenues divided by average total assets. So the product of the two is return on assets. Net profit margin is net profit divided by total revenues. Net profit is total revenues minus total cost. Total assets turnover is total revenues divided by average total assets, and average total assets is the sum of average non-current assets and average current assets. A pictorial representation of this kind is found very useful, and that is why this chart is very popular. DuPont chart may be extended to understand the determinants of return on equity. Return on equity is equal to return on assets multiplied by equity multiplier, also called leverage multiplier. Equity multiplier is defined as average total assets divided by average equity. In the case of Horizon Limited, this is 2. Return on assets is 13.7%, so return on equity is 27.4%. Since return on equity is a very important financial metric, this extension of DuPont chart is quite insightful. The DuPont chart and its extended version can be captured very neatly in the form of an equation shown here. Return on equity is a product of 3 factors: net profit margin, total asset turnover, and leverage multiplier. Return on equity is defined as net profit divided by average equity. In the case of Horizon Limited, it is 27.4%. As I mentioned, return on equity is perhaps the most important financial metric. So this equation tells us about the key determinants of return on equity. Net profit margin is defined as net profit divided by total revenues. It is 10% for Horizon Limited. Total asset turnover is total revenues divided by average total assets. It is 1.37, and leverage multiplier is average total assets divided by average equity. It is 2. We may consider this as a reflection of profitability, this as a measure of productivity, and this as an indication of leverage. So profitability multiplied by productivity multiplied by leverage gives us return on equity. This is the most powerful equation in financial statement analysis. This reflects how much money the firm is making for every rupee of revenues. This reflects how much of revenue is being generated for every rupee of assets deployed in the firm. This reflects how much of assets are being created for every rupee of equity being employed in the firm. So a multiplication of these three numbers gives us return on equity. So this is a very, very useful equation. Invariably, when I am doing financial analysis of a firm, I start with this equation. This then serves as a springboard for further examination and analysis. Given the importance of the extended version of DuPont equation, it bears repetition. Return on equity is equal to profitability multiplied by productivity multiplied by leverage. Profitability is net profit margin, productivity is asset turnover, and leverage is equity multiplier.
It is instructed to look at the comparative picture for few companies. Here is the DuPont equation for three companies as on 31st March 2022. The return on equity of Tata Steel was very impressive at 35.7%. Dr. Reddy's Laboratories had its ROE very less at 11.5% for the year 2022. That may be on account of a lower total asset turnover ratio. Godrej Consumer Products had an ROE of 15.1%, which is a kind of a norm for this company. Of course, here also it is slightly below par. If we look at a picture like this, we get an idea about how various drivers of return on equity influence the final outcome for different kinds of companies. Before we look into the key financial ratios of Hindustan Unilever, it is essential that we understand the definition of ROE, return on equity, and ROCE, return on capital employed, as prescribed by the accounting standards of ICAI. ROE is net profit after taxes minus preference dividend divided by average shareholders' equity. ROCE is EBIT divided by capital employed. Capital employed is the sum of tangible net worth, total debt, and deferred tax liability. An important point to note here is that while capital employed includes only the tangible assets of a company, the intangible assets will be counted while calculating the shareholders' equity. Though not required statutorily, some companies provide information on key financial ratios in the annual report. Hindustan Unilever Limited is one such company. Here are the key financial ratios of this company for the financial year 2021-22 drawn from its annual report. If we look at the ratios, we find that return on capital employed is exceptionally higher than return on net worth or return on equity. Let us understand why is it so. In the previous year, Hindustan Unilever acquired GlaxoSmithKline, and in that merger, they paid nearly 44,000 crores towards goodwill and other intangible assets and around 1,000 crores towards tangible assets. As we saw in the previous slide, intangible assets are included in the shareholders' equity while calculating ROE, and only tangible assets are counted in capital employed while calculating ROCE. It is clear that the denominator of ROE is much larger than ROCE and hence the difference. Basic earning per share is 37.53. Debtors turnover is 28.1. This is also very high, which means that the average collection period for the company is barely 13 days. One of the shortest average collection period. The company perhaps has very little credit or collects its receivables very efficiently. Inventory turnover ratio is also very high at 13.8, which suggests that it is very efficient in managing its operations. Interest coverage ratio is 129.2. It is high because the company has very little interest-bearing debt. Current ratio at 1.3 is fairly satisfactory. Debt to equity is 0.02. In the case of HUL, as we have seen in the balance sheet, the primary liability is on account of trade payables, which does not carry any interest whatsoever. HUL seemed to be in a very sweet spot where it has substantial credit available to it from its suppliers and vendors, and it grants very little credit to its customers or collects its receivables very quickly. Thanks to this combination, it has one of the exceptional ratios that we see in the chart. Operating profit margin is high at 22.6%. Net profit margin is also very high at 17.5%. So it has very high profitability, very high total asset turnover ratio, and very little interest-bearing debt. All these factors contribute to such wonderful financial metrics. Very few companies in India or even in the entire world have such favorable ratios. What we find interesting is that most of the ratios have improved year on year, which indicates that the company is constantly trying to improve itself.
So far we looked at absolute statements. Now we look at common size statements, also referred to as percent financial statements. The common size statement of profit and loss is shown in this table. Here we have the absolute statement. If you look at 20x1, you find total income is 1300 million, total expenses other than finance cost is 1090 million, so on and so forth. Now we express every item as a percent of total income. Total income in relation to total income is 100%. Total expenses in relation to total income are 84%. PBIT in relation to total income is 16%, so on and so forth. We have the common size statement for the previous year as well shown in this column. If we look at the two columns, we find that in percent terms there is no change whatsoever. This prima facie means that the performance is neither improved or deteriorated over 1 year. Now we turn our attention to the balance sheet. The regular balance sheet of Horizon Limited as at March 31st, 20x1 is shown here. The common size balance sheet is shown in this column. In the common size balance sheet, all items in the balance sheet are expressed as a percent of the total of the balance sheet. The total of the balance sheet is 1000 million. Non-current assets are 600 million. 600 million in relation to 1000 million is 60%. Current assets are 400 million in relation to 1000 million. Current assets are 40%. So on and so forth. All items in the balance sheet are expressed as a percent of the total of the balance sheet. We have the common size balance sheet for the previous year as well. This common size balance sheet is based on the regular balance sheet as shown in this column. When we compare the common size balance sheet of 20x1 with 20x0, we find that in percentage terms items have remained either the same or more or less the same. Here also it means that the performance apparently has neither improved nor deteriorated. Common base financial statements. In common base financial statements, the numbers of a year are expressed as a percent of the numbers in the base year. If we look at the statement of profit and loss of Horizon Limited for 2 years, 20x0 and 20x1, and regard 20x0 as the base year, then numbers in the base year in relation to the base year would obviously be 100%. Now we turn to 20x1 numbers. Total income in 20x1 is 1300 million. 1300 million in relation to 1180 million, which is a figure for the base year, is 110%. 1090 in relation to 995 million, which is the figure for the base year, is 110%. Likewise, we express numbers in 20x1 in relation to numbers in the base year, which is 20x0. If we look at the common size base statement, we find that total income has increased by 10%, PBIT is increased by 14%, tax burden is increased by 25%, and PAT is increased by 8%. So this gives a different insight into the financial performance of the company. The Common base balance sheet is constructed in a similar manner. We have the regular balance sheet of Horizon Limited for 20x0, which is the base year. So base year numbers in relation to base year would obviously be 100%. We have the regular balance sheet for 20x1. 20x1 number in relation to the base year number is shown here. So 600 in relation to 550 is 109, 400 in relation to 350 is 114, so on and so forth. So we find that in relation to the base year, non-current assets have increased by 9%, current assets have increased by 14%, other items have increased by 11%. This also provides a useful insight. Let us apply our knowledge of financial ratios to solve some problems. In the examination, you will have problems of this kind. A firm's current assets and current liabilities are 1,600 and 1,000 respectively. How much can it borrow on a short-term basis without reducing the current ratio below 1.25? The firm doesn't want its current ratio to fall below 1.25. Let us assume that whatever is borrowed on a short-term basis will be kept in a bank deposit or in the form of some other current asset. Let the maximum short-term borrowing be B. The current ratio with this borrowing should be 1.25. So we set up an equation like this. 1,600 plus B divided by 1,000 plus B is equal to 1.25. Solving this equation, we get B is equal to 1400. Hence, the maximum permissible short-term borrowing is 1400. You can see why it is 1400. When the firm has a short-term borrowing of 1400, this becomes 1600 plus 1400, that is 3000, and this becomes 2400. So 3000 divided by 2400 is 1.25. If B exceeds 1400, then this ratio will fall below 1.25, which is not acceptable to the firm. Here is another solved problem. Determine the sales of a firm given the following information. Current ratio 1.4, asset test ratio 1.2, current liability 1600, inventory turnover ratio 8. The sales figure may be derived as follows. Current assets are equal to current liabilities times current ratio. Remember, current ratio is current assets divided by current liabilities. So current assets can be obtained as a product of current liabilities and current ratio. In this case, 1600 multiplied by 1.4. So current assets are 2240. Current assets minus inventories, which are quick assets, can be defined as the product of current liabilities and asset test ratio. Remember, asset test ratio is quick assets divided by current liabilities. So if we want to find out what the quick assets are, we multiply current liabilities with asset test ratio. Current liabilities are 1600, asset test ratio is 1.2. So current assets minus inventories, which represent quick assets, is 1920. Since current assets are 2240 and quick assets are 1920, inventories would be the difference between the two, which is 320. Sales are equal to inventories multiplied by inventories turnover ratio. Inventories turnover ratio is given as 8, so 320 multiplied by 8 gives us the sales figure of 2560. Here is yet another solved problem. The following information is available for Zenith Steel Limited. Net profit margin 9%, asset turnover 0.9, equity multiplier 2, retention ratio or plowback ratio 0.8. What is the sustainable growth rate for Zenith Limited? As we have learned, sustainable growth rate is a product of return on equity and plowback ratio or retention ratio. And we've also learned that return on equity, according to the DuPont extended equation, is a product of net profit margin, asset turnover, and equity multiplier. So sustainable growth rate will be return on equity, which is the product of these three, multiplied by retention ratio or plowback ratio. Hence, the sustainable growth rate is 9% multiplied by 0.9 multiplied by 2 multiplied by 0.8. So the sustainable growth rate works out to 12.96%. Applications of financial statement analysis. Financial statement analysis is helpful in a variety of contexts such as assessing corporate excellence, predicting corporate bankruptcy, predicting bond ratings, equity selection. Assessing corporate excellence. Every year, the Economic Times gives Corporate Excellence Award for the Company of the Year and Emerging Company of the Year. For the Company of the Year award, companies which cross a certain threshold level of market capitalization and revenues are considered. The following financial indicators are used in the quantitative evaluation for judging corporate excellence: net sales, net profit, market capitalization, return on equity, share price return over 1 year, compound annual growth rate in revenue over the past 3 years, compound annual growth rate in profit over the past 3 years. To judge corporate excellence, other studies have employed different sets of financial indicators. Predicting corporate bankruptcy. Edward Altman carried out a classic study on prediction of corporate bankruptcy. He found that a linear function of 5 variables discriminated best between the bankrupt and non-bankrupt firms. These 5 variables are: 1. Working capital to total assets; 2. Retained earnings to total assets; 3. EBIT to total assets; 4. Market value of equity to book value of debt; and 5. Sales to total asset. This classic work of Altman triggered a number of studies all around the world. In India also several studies have been done, and they found that a set of financial variables does help in predicting corporate bankruptcy. Predicting bond ratings. Can financial ratios be used for predicting bond ratings? The empirical answer is a yes. Kaplan and Horwitz found that in general, a lower debt ratio, a higher interest coverage ratio, a higher return on assets ratio, a larger size, a lower market risk, and a lower unique risk had a favorable influence on bond ratings. They combined these variables into a single measure of bond quality and examined how well it could predict Moody's bond ratings. They found a very close correspondence between predicted ratings and actual ratings for a sample of newly issued bonds. Similar work has been done in many countries, including India, and the results of such studies suggest that a judicious combination of financial ratios is helpful in predicting bond ratings. Equity selection. Joel Greenblatt, an eminent investment manager in the US, has written an interesting book titled The Little Book That Beats the Market. In this book, he offers a magic formula for selecting stock based on two criteria: return on invested capital and price earnings ratio. Other things being equal, the higher the ROIC, the more attractive a stock is. Other things being equal, lower the P ratio, the more attractive the stock is. He ranks 3,000 stocks in the US on these two criteria. As far as ROIC criterion is concerned, stocks are ranked in a descending order because higher the ROIC, more attractive the stock is. As far as P ratio is concerned, stocks are ranked in an ascending order because lower the P ratio, the more attractive the stock is, other things being equal. Here is an illustrative ranking. Let us assume that Google has a very high ROIC. It has the highest ROIC among these 3,000 stocks. This is just pure illustration. So it gets a rank of 1. Google has a very high P ratio. So when stocks are ordered in an ascending fashion on the P ratio criterion, then Google may have a rank of 2500 or so. Add these two numbers and you get 2501. According to him, the magic formula for selecting stocks involves combining stocks with the lowest combined score. He says, create a portfolio of 25 stocks which have the lowest combined score by investing an equal amount in each of these 25 stocks. Revise the portfolio every year. According to him, this strategy is a market beating strategy, and he has shown historically such a strategy has worked extremely well. Equity selection coffee can portfolio. Coffee can portfolio idea was first proposed by Robert Kirby, a portfolio manager with Capital Group in the US. Saurabh Mukherjee, an investment manager in India, has written a book titled The Unusual Billionaires. In this book, he argues that the coffee can portfolio idea works very well in India. He examined the data for listed stocks in India over a 10-year period and applied three filters: market cap of rupees 100 crore or more every year, revenue growth of at least 10% every year, return on capital employed, which he defines as earnings before interest and taxes divided by capital employed, of 15% every year. He found that only 5 stocks satisfied these three criteria over a 10-year period. So in 2000, if a coffee can portfolio of these 5 stocks was created and held for the following year, 10 years, it would have delivered an annual return of 19.3%. The coffee can portfolio that was created in 2000 consisted of 5 stocks: NIIT, Hero Motors, Swaraj Engines, HDFC. A portfolio of these 5 stocks in which equal investment was made in each of these stocks created in 2000 and held for the following 10 years would have delivered an annual return of 19.3%, which was significantly higher than the rate of return generated by Nifty index. Problems in financial statement analysis. Financial statement analysis is not a simple, straightforward exercise. There are several problems associated with financial statement analysis. 1. Heuristic and intuitive character. Financial ratios have been suggested in a heuristic and intuitive manner. Often there is no underlying theory for these ratios. So the analyst has to grapple with a situation where ratios do not have a very sound theoretical foundation. 2. Development of benchmarks. The question that often arises is what should be the standard or benchmark against which the ratio of a firm should be compared? Should it be the best performer in the industry? Should it be the average performer in the industry? The problem gets compounded for firms which are engaged in multiple businesses. When a firm is engaged in several businesses, there is no well-defined benchmark to compare its ratios against. 3. Window dressing. We have learned that financial statements are self-report cards. Almost invariably, there is some massaging or window dressing. You require greater understanding of accounting technicalities to uncover window dressing. 4. Price level changes. We have learned that financial statements are based on the historical cost principle. Over a period of time, thanks to inflation, actual prices move, but financial statements are still cast in terms of historical prices. Hence, it is very difficult to compare performance over a period of time. There is a move toward fair level accounting, but that move or fair level accounting proposition also has its challenges and problems associated with it. 5. Variations in accounting policies. Firms adopt different kinds of accounting policies. A firm may adopt very conservative accounting policies. Another firm may adopt very aggressive accounting policies. It is very difficult to compare the ratios of firms which have very divergent accounting policies. 6. Interpretation of ratios. Ratios don't lend themselves to straightforward interpretation. A high inventory turnover ratio may suggest the firm is very efficient in managing its inventory, but it can also mean that the firm has very limited inventory and it is losing business on account of that. A high fixed asset turnover ratio may suggest the firm is very productive in utilizing its fixed assets, but it is also likely the firm has worn out obsolete equipments which have a low book value. A high current ratio may suggest that the firm has a very comfortable liquidity position. However, it may mean that it has bloated inventories which are very sticky in nature. So ratios cannot be interpreted very simply. Potential red flags. As an analyst, you should learn to identify potential red flags. Here is a list of common red flags. 1. A qualified audit opinion. If there is a qualification in the audit report, prima facie, it suggests a weakness. 2. A change in accounting policy that is not satisfactorily explained. When a firm changes its accounting policy, it has to offer an explanation. If the explanation is not satisfactory, it suggests that there is some kind of manipulation. 3. An unusual increase in accruals. If there is an unusual increase in accruals like payables and receivables, you have to find out the underlying source. 4. A widening gap between reported income and cash flow from operations. If there is a gap between reported income and cash flow from operations which is widening over a period of time, there is a reason to suspect the quality of accounting information. 5. Large adjustments in the fourth quarter. If the firm makes a lot of adjustments in the fourth quarter, then obviously there is something it is doing in order to boost a sagging bottom line. 6. An abrupt change in external or internal auditor. If there is an unexpected and abrupt change in the external auditor or internal auditor, one has to be suspicious of the quality of accounting information. 7. An increase in related party transactions. Companies are required to report on related party transactions. If there is a significant increase in related party transactions, prima facie, it means that some kind of manipulation is taking place. Here are 7 useful guidelines for financial statement analysis. 1. Use ratios to get clues to ask the right questions. Ratios by themselves don't provide the answer, they only provide clues to ask the right question. Suppose the net profit margin of a firm is low. You have to ask, is it because the firm does not have pricing power? Is it because the raw material cost is very high? Is it because the selling and distribution costs are very high? Is it because R&D costs are very high? So on and so forth. To be selective in the choice of ratios, I have a simple rule of thumb which I call as 357. When I have to do a quick and dirty financial analysis of a firm, I look at 3 numbers or ratios: return on equity, sales growth rate, and price earnings multiple. If I had to expand my analysis slightly, I add 2 more ratios: return on invested capital and debt equity ratio. If I had to further expand my analysis, I look at free cash flow and sustainable growth rate. This is my list. You will have to select ratios that make sense to you. But remember this rule of thumb 357. Under extraordinary circumstances, you can expand your analysis, but for most purposes, this will suffice. It is very difficult for us to comprehend more than 7 numbers. There is a cognitive limitation characterizing most of us. That is why often we find that everything is in terms of sevens. There are 7 days to a week, there are 7 colors, there are 7 ragas, there are 7 sins, there are 7 hills, and so on. There is something magical about the number 7. We are not Shakuntala Devi, we are ordinary human beings with cognitive limitations. We have to respect those limitations and be very selective in the choice of ratios. 3. Employ proper benchmarks. This is very important. If you use wrong benchmarks, you will get very different picture. 4. Know the tricks used by accountants. We have learned that accountants have a variety of tools or techniques by which they can manage accounts, and you need to deepen your understanding of accounting. 5. Read the notes to accounts. The notes to accounts provide a lot of valuable information. You cannot read financial statements unless you read notes to accounts. Sometimes people find it very inconvenient, difficult to read the notes to account. But if you want to get a very accurate picture, you have to read the notes to accounts. 6. Understand how the ratios are interrelated. We have seen that ratios are interrelated. The most important equation in financial statement analysis is the extended DuPont analysis, which says return on equity is the product of net profit margin, total asset turnover, and equity multiplier. 7. Remember, financial statement analysis is an odd mixture of art and science. Financial statement analysis is neither art nor science. It is an odd mixture of art and science. It calls for care, circumspection, and good judgment. Here is a graph which shows the relationship between number of ratios and informational content. If you look at this graph, you'll find that most of the information found in financial statements can be extracted with the help of 7 well-chosen ratios. If you add more and more ratios, you are not likely to get much additional information content. On the contrary, you may be confused and confounded. In fact, it becomes dysfunctional beyond a certain point to add more ratios. Comprehensive business analysis calls for looking beyond financial measures to understand the qualitative factors that are relevant for judging the prospects of the firm. Here is a list of 7 questions suggested by American Association of Individual Investors. 1. Are the company's revenues tied to one key customer? 2. To what extent are the company's revenues tied to one key product? 3. To what extent does the company rely on a single supplier? 4. What percentage of the company's business is generated overseas? 5. What is the extent of competition the company is facing? 6. What are the future prospects of the company and the industry? 7. What is the legal and regulatory environment that has a bearing on the company's future? We have to go beyond financial measures to get a balanced understanding of the firm. Financial measures such as profit margin and return on equity provide a tale of business performance, but these traditional measures aren't the buttons that managers can push to make things happen. They are backward-looking measures. Frustrated by the inadequacies of traditional performance measurement systems, some managers have shifted their attention to operational measures. Firms use a wide range of non-financial measures. The important ones are listed here. Customer satisfaction. What is the level of customer satisfaction? Is it improving, deteriorating, or remaining the same? Customer returns. What proportion of goods sold have been returned by customers? Market share. Is the market share of the firm improving, deteriorating, or remaining the same? New product introduction. What proportion of products currently selling have been introduced in the market in the last 3 years? What is the share of new products in the total revenues of the firm? On-time delivery. Is the firm making its deliveries on time? Manufacturing cycle time. Is the manufacturing cycle shortening or lengthening or remaining the same? Defects percentage. What proportion of goods are found to be defective? Employee satisfaction. Is the employee satisfaction improving, deteriorating, or remaining the same? Employee productivity index. Is the employee productivity index improving or deteriorating or remaining the same? Patents obtained. How many patents have the firm obtained in the last 1, 2, and 3 years? The balanced scorecard approach, pioneered by Robert Kaplan, David Norton, and others, seeks to develop an integrated performance measurement system. They claim that the balanced scorecard has three distinctive features. One, it is strategy driven. Two, it covers four important perspectives in a business, namely financial, customer, internal business, and learning and growth. Three, it represents a linked series of objectives and measures. In their seminal work, The Balanced Scorecard, Robert Kaplan and David Norton suggest that a firm should be viewed from four perspectives. Financial perspective, how do we appear to our shareholders? Customer perspective, how do our customers see us? Internal business perspective, what must we excel at? Innovation and learning perspective, how can we continue to improve and innovate? Recognizing that return on capital employed is a very central objective of business enterprise, Kaplan and Norton have suggested a cause-effect relationship among four perspectives in a diagram like this. Employee skills, which reflect learning and growth, have a bearing on process quality and process cycle time. If process quality is good and process cycle time is less, the firm can effect on-time delivery of quality goods and services. On-time delivery of quality goods and services generates customer loyalty, which is very important from the customer perspective point of view. And customer loyalty is eventually the foundation for improved return on capital employed. The balance scorecard has been augmented and modified by companies to suit their requirements. Here is an example of such augmentation done by ABB. ABB's balance scorecard has five perspectives. In addition to the four traditional perspectives, it has process and supplier perspective. ABB believes that if a company has an excellent long-term relationship with its suppliers and vendors, if a company has highly trained, talented, and motivated employees, if a company has a strong innovation and development orientation, the company is likely to satisfy customer requirements, and if customers are satisfied and loyal, financial performance is expected to improve. Frequently cited balance scorecard measures. Financial perspective. Income measures, operating income, gross margin percentage. Revenue and cost measures, revenue growth, revenues from new products, cost reductions in key areas. Income and investment measure, economic value added, return on investment. Customer perspective, market share, customer satisfaction, customer retention percentage, time taken to fulfill customers' requests, number of customer complaints. Internal business process perspective, innovation process, operating capabilities, number of new products or services, new product development times, and number of new patents. Operations process, yield, defect rate, time taken to deliver product to customers, percentage of on-time deliveries, average time taken to respond to orders, setup time, manufacturing downtime, post-sales service process, time taken to replace or repair defective products, hours of customer training for using the product. Learning and growth perspective, employee measures, employee education and skill levels, employee satisfaction ratings, employee turnover rates, percentage of employee suggestions, implemented, percentage of compensation based on individual and team incentives, technology measures, information system availability, percentage of processes with advanced controls. Balanced scorecard offers certain advantages. One, it focuses on critical measures. Two, it highlights the key elements of competitive agenda. Three, it serves as a check against sub-optimization. However, balanced scorecard is not an unmixed blessing. It has its disadvantages too. One, it is difficult to establish reliable cause-effect relationship. Two, managerial attention is likely to be fixated on short-term financial results because often managerial incentive compensation is linked to short-term financial results. Three, there is a genuine possibility of measurement overload. In 4 areas of balanced scorecard, there may be 16 to 24 measures. In one organization, I came across 36 measures. It is very difficult to comprehend what is going on if you have so many measures. 4. It is difficult to establish trade-offs when measures point in different directions. A strategy map is a simple graphic that shows the logical cause and effect connection between strategic objectives shown as ovals on the map. It is one of the most powerful elements in the balanced scorecard methodology. It communicates how value is created by the organization. Here is an illustrative strategy map for Chipset Incorporated for 2017. Empower workforce, align employee and organizational goals, develop process skills, enhance information system capabilities, improve processes, improve manufacturing quality and productivity, improve manufacturing capability, reduce delivery time to customers, meet specified delivery dates, improve processes, increase customer satisfaction, increase market share, grow operating income, increase shareholder value. This map has been drawn from the book Horn-Grain's Cost Accounting, a Managerial Approach, 17th edition, published by Pearson. While quite popular, Balanced Scorecard has its own critiques. Thomas Copeland and Aaron Dolgap, proponents of expectations-based management, are critical of balanced scorecard. They said balanced scorecards are the mud pie in finance. They may or may not be actually logically tied to wealth creation. Usually they are not expectations-based. Often their components are self-contradictory, and even when appropriate, their components are redundant. They added, rather than being clear, balanced scorecards muddy the waters in a misguided attempt to mollify multiple constituencies. Here is a list of top 10 key performance indicators to use. 1. Revenue growth rate. 2. Net profit margin. 3. Cash conversion cycle or cash cycle. 4. Net promoter score. Net promoter score measures the extent to which customers are satisfied and loyal. NPS or net promoter score is measured in this manner: percentage of promoters minus percentage of detractors. On a scale of 0 to 10, customers are asked to answer a simple question: how likely is it that you would recommend your company or your product or service to a friend or colleague? Customers who give a score of 9 to 10 are regarded as promoters. Those who give a score of 7 to 8 are regarded as passives. Those who give a score of 0 to 6 are regarded as detractors. So NPS is percentage of promoters minus percentage of detractors. 5. Customer engagement. To what extent are our customers engaged with our organization? Loyalty and engagement go beyond satisfaction. The most popular measure of customer engagement in the US is Gallup's customer engagement ratio, known as CE11, because it seeks answers to 11 engagement questions, 8 emotional attachment questions, and 3 rational loyalty questions to quantify customer engagement. Many of you may be aware that Gallup organization is a very famous organization which elicits opinions on a variety of issues using small samples. Once a lady approached Mr. Gallup and said, "I have never been contacted in any of your surveys." Mr. Gallup told this lady that we use a very small random sample of people for our surveys, so the probability that you will be contacted is as low as the probability of your being hit by lightning. The lady replied, "Sir, but I have been already hit by lightning." 6. Customer profitability. To what extent are we generating profits from our customers? Customer profitability is not a static score and covers several different time frames. Historical value, value earned during the last 1 year. Current value, value earned during the last 1 month. Present value, expected value to be earned in the future. 7. Relative market share. Relative market share is organization's market share divided by largest competitor's market share multiplied by 100 to get a percent figure. 8. Capacity utilization rate. Actual capacity in time period divided by possible capacity in time period multiplied by 100. 9. Staff advocacy score. To what extent are the employees advocates of our business? Staff advocacy score is similar to Net Promoter Score. On a scale of 0 to 10, employees are ranked as advocates if they give a rating of 9 to 10, or passives if they give a rating of 7 to 8, or detractors if they give a rating of 0 to 6. Staff advocacy score is percent of advocates minus percent of detractors. In sustainability index, the sustainability index is a KPI companies can create based on a number of indicators including carbon footprint, water footprint, energy consumption, waste, recycling, and others. Every organization has to create its own composite formula of sustainability based on issues which are most relevant to its business or industry. An agency of the US government has instituted an award called the Baldrige Award for recognizing corporate excellence. Corporate excellence is measured in terms of 7 criteria: leadership, strategic planning, customer and market focus, information and analysis, human resource focus, process management, and business results. In India, the House of Tatas have instituted an award called Tata Business Excellence Model, which is patterned after the Baldrige Award. Tata Business Excellence Model, patterned after the Baldrige Award, the Tata Business Excellence Model, adopted by the Business House of Tata in India, evaluates the performance of Tata companies along 7 categories of criteria. The categories and the points assigned to them are shown below. Leadership 125, strategic planning 85, customer focus 85, measurement analysis and knowledge management 85, workforce focus 85, operations focus 85, results 450, total points 1000. Tata Business Excellence Model, or TBEM, works under the aegis of Tata Quality Management Services, an in-house organization mandated to help different Tata companies achieve business excellence. In recent years, the TBM framework has been adapted to include new business and social initiatives such as governance, safety, climate change, and innovation. The TBM movement in Tata Group has built-in reward and recognition mechanism wherein companies that have achieved a score of 600 or more on the TBM framework are felicitated with the JRD QV award. Recently, Titan received this award. TBM seeks to strengthen the competitiveness of Tata companies by A. Improving business excellence practices, capabilities, and results. B. Facilitating communication within a common language of excellence across all Tata companies and the sharing of best practices among them. And C. Serving as a working tool for understanding and managing performance, for providing planning guidance, and for identifying learning opportunities. European Business Excellence Model is widely used in Europe. This model is based on 9 factors: leadership, people management, policy and strategy, resources, processes, people satisfaction, customer satisfaction, impact on society, business results. These 5 factors are referred to as enablers Collectively, they have a weightage of 50%, and individually the weights are shown here. These four factors are referred to as results. Collectively, they have a weightage of 50%, and individual weights are reflected here. You can see that this model is very comprehensive in covering all the important dimensions of business. Somewhat similar to the balance scorecard is McKinsey's generic health metrics framework. McKinsey uses this framework to understand the determinants of value and the drivers of value. Intrinsic value is determined by financial drivers such as long-term growth, return on invested capital, and cost of capital. These are the proximate drivers of intrinsic value. Financial value drivers in turn are influenced by short-term value drivers such as sales productivity, operating cost productivity, and capital productivity. Short-term value drivers in turn are influenced by medium-term value drivers such as commercial health, cost structure health, and asset health. Medium-term value drivers in turn are influenced by long-term value drivers such as strategic health, core business, growth opportunities. All these are related in a very integrated framework used by McKinsey to understand the drivers of value. Increasingly, business results are presented outside the traditional financial statement format. Same store sales, order book position, average revenue per user, return on invested capital, earnings before interest, tax, depreciation, amortization, economic value added, and so on are some of the metrics that we commonly find in annual reports. Since they are outside the realm of generally accepted accounting policies, companies have more latitude in calculating and reporting these metrics. Metrics have become a fact of business life. They're essential for measuring performance and executing strategy. However, metrics are inherently imperfect, and most of them are used to quantify intangible goals. For example, a company may be interested in delighting customers, so they conduct online surveys to find out whether customers are being delighted or not. Employees who conduct the survey try to maximize the survey score by pestering, nudging, or prodding the customers to give good scores. They confuse what is being measured with the metric itself. This tendency is called surrogation, and it leads to the tyranny of numbers. A survey has shown that the most valued non-financial data are 1. Execution of corporate strategy, 2. Management credibility, stroke quality of corporate strategy, 3. Innovativeness, 4. Ability to attract employees, 5. Market share, 6. Management experience, 7. Quality of compensation policies, 8. Research leadership, 9. Quality processes, 10. Customer satisfaction. Let us sum up our discussion. Financial statement analysis provides valuable insights into financial performance, position, and prospects. The principal tools of financial statement analysis are financial ratio analysis, DuPont analysis, and percent format statement. Financial ratios may be divided into 6 categories: liquidity ratios, leverage ratios, turnover ratios, profitability ratios, growth ratios, valuation ratios. Liquidity ratios reflect the short-term solvency of the firm. Leverage ratios measure the extent to which the firm is using debt capital. Turnover ratios indicate the efficiency with which the firm is deploying various assets like receivables, inventories, and fixed assets. Profitability ratios measure profit margins and rates of return. Growth ratios indicate the growth performance of the firm, primarily in terms of revenues. Valuation ratios reflect the view of investors about the firm. Here is my list of 7 most important financial ratios or numbers. Current ratio is defined as current liabilities by current assets. Debt equity ratio is defined as total liabilities by net worth or equity. Compound annual growth rate in revenues measured over a period of 5 to 10 years. Return on equity defined as profit after tax divided by shareholders' funds. Return on capital employed defined as net operating profit after tax divided by capital employed price earnings ratio defined as market price per share divided by earnings per share. Free cash flow reflects the cash flow available for distribution to investors after meeting the growth requirements of the firm. The financial ratios of a company are compared with some benchmark ratios. The benchmark ratios may be the ratios of the industry average or the best performing company in the industry. The DuPont chart is a popular tool of financial analysis. It shows the determinants of the return on equity, which are net profit margin, total asset turnover, and equity multiplier. There are several problems and issues in financial statement analysis that call for care, circumspection, and judgment. The commonly employed non-financial performance measures are customer satisfaction, market share, manufacturing cycle time, defects percentage, employee satisfaction, and carbon footprint. The balanced scorecard approach, pioneered by Robert Kaplan, David Norton, and others, seeks to develop an integrated performance measurement system. The balanced scorecard covers four important perspectives in a business, namely financial, customer, internal business, and learning and growth. The Baldrige Award, the European Business Excellence Award, and the Deming Prize are important awards for corporate excellence. In India, the Business House of Tatas has evolved the Tata Business Excellence model for the companies in the Tata Group. There is a real danger of measurement overload and tyranny of numbers. If you wish to explore the subject of financial statement analysis in greater detail, here is my recommendation: Analysis of Financial Statements by Bernstein and Wild. The most popular work on the balanced scorecard is The Balanced Scorecard by Robert Kaplan and David Norton. Thank you.